I was actually not planning on doing a live stream show tonight. I had an interview booked. I had it confirmed hours ago. I was in the conference call. On the conference call line, waiting for the guest to call in, and unfortunately, even after the confirmation a couple hours before the interview, the guest didn't show up, and then the guest's assistant and the guest didn't respond to a number of emails. So this happens when you book interviews. I am trying. It was a big name guest. I will try to reschedule it. But tonight we're going to do the show on the oil market, because oil prices have been rallying this week. So the oil prices, before we get into some of the stories, the oil market, the prices of oil are now, for WTI, they are back right around almost $60 a barrel at $59.20. It is up today over 1.32%. Brent crude is up even more at 1.58%. Up to almost $65 a barrel at $64.39. So there's been a pretty big rally in the crude oil market. There has not been this big a rally since a week or two before Repo Madness started in mid-September there, September 16th and 17th, because remember, there was the Saudi refinery story a couple months ago, and that caused a temporary spike in oil, and then the Saudis said production was online pretty quickly, and there was counter stories that were countering that, saying that it wasn't true. And then within a couple weeks or so, a lot of the Saudi production was actually back online with their production numbers. So oil prices are back, and it's not because a lot of these oil companies are well run. It's because Saudis and OPEC Plus have decided that in addition to the production cuts that they've already done, that they're going to do even more. So you can see part of that headline on there from oilprice.com. That's the story from today. The story is from Tom Kool, Kool. That's a cool last name, literally. And his article is "Oil Jumps on, quote, Saudi Surprise." And the main part of the headline is oil jumped because of news from Vienna, OPEC Plus, which are OPEC and the other countries that are non-OPEC members but have a lot of oil production. So I believe they let Russia and Mexico and some of these other countries that are not technically in OPEC, they're also allowed, since they're big oil producers, to attend the meetings and have representatives there. Agreed to cut 500,000 barrels per day more of oil than the current arrangement, a figure that initially raised questions on Thursday. However, on Friday, Saudi officials said they would maintain their unilateral cuts beyond what is required in order to defend oil prices. The markets responded with a bounce. OPEC Plus agrees to cut another 500,000 barrels per day. OPEC Plus agreed to cut production by an additional 500,000 barrels per day, with the cuts to last until March. But because the group is already producing below its current limit, there were questions about whether the cuts, in air quotes, were in fact consequential. Quote, "If we were to have an outcome of an extension of cuts with only the official quota of the OPEC Plus group being reviewed lower, the 500,000 barrels per day, rather than actual production, then the change in supply policy would be cosmetic, given below target production in some countries, notably Saudi Arabia and Angola," said Harry, I'm going to screw up his last name, Harry, I just won't try pronouncing his last name. You can read it in the article, global oil strategist at BNP Paribas. The Saudis are promising to maintain the unilateral cut, which is dicey in and of itself, given the history of OPEC. When they do announce cuts, that there's routinely cheating from a lot of countries. There's stories, I've talked with floor traders in the oil market, in the oil pits there in Chicago and elsewhere, of hearing how large amounts of oil are for sale from the Iranians, in the black market, and other oil-producing countries are willing to sell it too. And large oil-producing companies are willing to buy it on the black market. And a lot of people know about this, and normally there's not a lot of fines. Occasionally there's some fines, but normally not a lot. No one goes to prison or anything like that. It's just funny that OPEC is so inefficient, let's just say that, because OPEC is a cartel, but they do have a lot of influence over the oil price, whether they're trying to kill the shale oil drillers for a couple years, and that failed epically. And now they had to do even more cuts. So Saudi promises to maintain unilateral cuts. Quote, "We will continue the voluntary cut of 400,000 barrels per day," Energy Minister Prince Abdulaziz bin Salman said, sending oil prices much higher with those cuts in hand and full compliance from other members. If it can be achieved, the cuts could end up being substantially deeper. So the U.S. has become a net petroleum exporter. In September, the U.S. exported 89,000 barrels of crude and petroleum products, the first month since 1973 that its overall petroleum balance was net positive. A decade ago, the U.S. was importing 10 million barrels per day on a net basis. And the Saudis are still trying to do the Aramco IPO. But the main question here is about the shale oil companies. So will this rally in the oil prices, is it enough if oil prices can stay at these levels? And that's a big if, considering the problems in the global economy and how demand may start to weaken for oil, maybe in China or emerging markets, if the shale oil companies can be saved. Because there's been a number of articles coming out in the last couple weeks, whether that's by Wolf Richter over at Wolf Street, Nick Cunningham, who writes for oilprice.com. Oilprice.com is probably the best free resource for doing research on the oil market. There is an extensive amount, whether it's different oil price quotes on the different types of oil, Brent crude, WTI, some of the others, and also articles, well-written articles. Oilprice.com is the best, I would say, free resource for the oil market. Nick Cunningham wrote a new article recently, yesterday, about shale's debt-fueled drilling boom is coming to an end. So his article is the financial struggles of the U.S. shale industry are becoming increasingly hard to ignore, but drillers in Appalachia are in particularly bad shape. The Permian has recently seen job losses, and for the first time since 2016, the hottest shale basin in the world has seen job growth lag the broader Texas economy. The industry is cutting back amid heightened financial scrutiny from investors as debt-fueled drilling has become increasingly hard to justify, but exploration and production companies focused almost exclusively on gas, such as those in the Marcellus and Utica shales, are in even worse shape. An IEEFA analysis found that 7 of the largest producers in Appalachia burned through about $500 million in the third quarter. Gas production continues to rise, but profits remain elusive. So they're growing revenue. I've talked about this for months now, where these shale oil producers and shale gas producers cannot cut back production because either they have hedges and they have to deliver the oil or the gas into the hedges at a higher price, or they have so much debt on their balance sheet and they need any cash at all, any revenue at all, to make the interest payments, that they're actually producing at a loss because this delays bankruptcy. They're gambling that prices, that even if they're producing break even or at a loss, they're gambling that prices for oil or for gas, natural gas, can turn around. And even though they're losing money now, that the prices will rebound and that they can survive until the prices rebound. There's been massive capex cuts in the shale oil industry, though, hundreds of billions of dollars. Some of my friends are Hedgeye subscribers, and they've been telling me that Hedgeye's been bullish oil. I don't know if they were predicting these OPEC production cuts or not. I think Hedgeye apparently is bullish oil service companies. So there's a warning here about some of the oil service companies. They're not all equal. Okay, this is not financial advice, just my opinion. But you have to be careful unless you're buying an oil sector services ETF, like the Van Eck Vectors Oil Services ETF, which is OIH, Oscar Israel Harry. That one got as low in early October 9th at $10.84, and it was as high in April 22nd as $18.50. So it's been in a downtrend since the end of April, and it has had a few brief rallies. It rallied briefly through September 16th there, which was right before Repo Madness, right when we got Repo Madness. Remember, that was the Saudi refinery. So there was a big spike then from 1096 at the end of August on that ETF up to 1416, and then it went back down again and retested at 1082 on October 8th. But it's been firming up there in a range, and it looks like it could be building a nice base here. So that will give you a diversified portfolio exposure to oil services companies, but all the individual oil service companies are not created equally. A lot of them do have a lot of debt on the balance sheet. They have slashed CapEx bills enormously. They have fired workers. They've asked workers who have stayed on board. A lot of them have had to take pay cuts from what I'm hearing from my contacts. And what normally happens with the oil service industry is for these guys to keep drilling to get business from E&P companies, exploration and production companies, to drill wells. They have during the bear market, when prices are falling, they have to discount very, very heavily. So if you are going, and this is research, again, just my opinion, I'm not going to name any more specifics, just my opinion, not financial advice. But if you're going to look at any individual one of those companies and you're going to do fundamental research more than just looking at a chart, you need to go in there and look at the income statements and compare margins. So you need to look at balance sheet, how much debt, how much cash do they have, how much cash flow is the company generating at lower oil prices? How much are they discounting if they're a service company to still get business? And you can check that with margins in the income statement. And you can compare margins from the past to now. So if margins fall too much, then the company is cutting prices, and their margins are falling too much just to get any business, and they're actually losing money then drilling. My friend and former coworker Robert Rapier, who I worked with for about basically a full year at Investing Daily as an oil and energy analyst, working with him on a couple of paid investment newsletter writers, and on a couple of paid investment newsletters, and I've interviewed him many times over the years in the archives, many times. Maybe I'll get him on here again in the near future. And he just came out with a new article in the last day or two for oilprice.com, probably the best free resource. Normally, for articles this good, Robert puts them behind the paywall on Investing Daily or elsewhere. And this article talks about it's the oil company built to survive the bear market, and he's talking about ConocoPhillips and how ConocoPhillips they've cut their debt enormously and cut costs, and ConocoPhillips cash flow right now is actually stronger than it was, let me quote the part of the article, stronger than it was when oil prices were a lot higher. The net result has been a steady increase in the company's cash flow since the deep downturn in 2015. Cash flow has increased each year. In fact, today, ConocoPhillips is generating more cash flow with oil prices in the $50 range than it was in 2013 when oil prices were over $100. Free cash flow generation of $1 billion. Repurchased $750 million of shares with free cash flow and paid $340 million in dividends. Pretty impressive. That's how an oil company should be run. EOG Resources is doing very similar things. They've been cutting debt, focusing on margins, and trying to increase free cash flow, cutting costs. Cutting debt, cutting costs, trying to maintain or increase margins. That's what should be doing now. Oil companies should be doing now. But the oil service companies got to be careful with. I know Hedgeye is recommending them. That's what I've heard. $782. You want your $1,600 an ounce gold by the end of December? We still got a couple more weeks. Anything can happen. We'll see what happens with the Fed's official balance sheet. Even if I'm wrong about that $1,600 an ounce gold call, I'm still going to be right with my investments. So that's the best thing. Actually, if the gold price stays low for another 6 months, Sandstorm Gold's just going to do more deals. They just got their revolving credit facility extended to $300 million, and the bankers that supply their revolving credit facility lowered their interest rates on the credit facility because they have more diversified cash flow. So they got rewarded. They pay less interest rates now on that. So like I said, my investment portfolio is set up to benefit from paper price smashes. So the manipulators, the bullion banks can smash the dollar gold price all they want. Long term, I'm just going to benefit more. I've been thinking about buying more Sandstorm Gold shares too. I may buy some more. I'll let you guys know if I do. Pudenda says we need some bankruptcies in Shale. I totally agree. 100%. 100%. And there's not as much dumb money from pension funds as there has been in the past. Pension funds and junk bond money, people who are desperate for yield, put over $1 trillion into shale oil. $1 trillion. And there's been very little positive returns. EOG Resources has been the only consistent company that has generated free cash flow. EOG runs read up on articles on them. I think they get a return on equity of 17%, which is very impressive for an oil company. So they're a rare outlier. The rest of the industry for publicly traded shale oil and gas companies has been a destroyer of capital. So there's Silicon Valley unicorn IPO companies, revenue growth only. The shale oil producers and shale gas producers have been very similar to the Silicon Valley unicorn companies, except it's a commodity business, a cyclical business that's a lot more capital intensive, a lot more capex is required. Hey Andy, you're going to be fighting off SoftBank with a stick. SoftBank has a monopoly on those unicorn IPOs. If they can raise debt from hungry Japanese yield-starved Japanese bond investors for 1% to 3%, especially because SoftBank is marketing this at their baseball games in Japan, I think with like dancing pop stars, J-pop. So they take advantage of to invest in the bonds, and then they take the money that they made from selling the bonds to Japanese bond investors, and then they gamble on Silicon Valley unicorn IPOs. Also Chinese unicorn IPOs too. I heard a weird story about the CEO of SoftBank, and he invited like the CEO of China's Uber into his office, and he offered the guy a lot of money, and the CEO of China's Uber said, "I don't want your money, you're offering me too much money." And the SoftBank CEO, Masa-san, said, "If you don't take the money, I'm going to invest it all in all your competitors." So guess what the CEO of the Chinese version of Uber did? Also, and this should be no surprise, Iran said we won't agree to any production cuts in the future because Iran needs, most of their budget revenues are from oil production. Also, Iran hates the Saudis. Iran hates the US. The Iranian government. The Iranian people, it's different between the Iranian people and the US. I think a lot of people in Iran like the US. It's the Iranian government that hates the US. And vice versa. But the Iranian government said that they're not going to honor OPEC's production cuts. But that should be no surprise if you follow the oil market, because Iran has routinely cheated for a long time on production quotas. They're routinely known as one of the worst cheaters of any of the OPEC countries. So I have a number of other articles here in addition to the Nick Cunningham articles. Okay, back to the Nick Cunningham article here. Gas production continues to rise. Profits remain elusive. Despite booming gas output, Appalachian oil and gas companies consistently failed to produce positive cash flow over the past 5 quarters, the authors of the IEEFA report said. So it's wasteful. It's revenue only. They're producing this just to delay bankruptcy. It's not efficient at all. It's growth for growth's sake, as my friend Nolan Watson would say. They're not doing it efficiently at all. Of the 7 companies analyzed, 5 had negative cash flow. Well, that's real bad. Including Antero Resources, Chesapeake Energy. I think Chesapeake Energy just arranged some type of deal to delay bankruptcy. So they're not going to file bankruptcy anytime soon. I think they just did a temporary deal that buys them another few months or so. EQT, Range Resources, and Southwestern Energy. Only Cabot Oil and Gas and Gulfport Energy had positive cash flow in the 3rd quarter. The sector was weighed down by a sharp drop in natural gas prices, with Henry Hub off by 18% compared to a year earlier, but the losses are highly problematic. After all, we are more than a decade into the shale revolution, and the industry is still not really able to post positive cash flow. Yikes. Worse, these are not the laggards. These are the largest producers in the region. The outlook is not encouraging. The gas glut is expected to stick around for a few years. Bank of America Merrill Lynch has repeatedly warned that unless there is an unusually frigid winter, which could lead to higher than expected demand, the gas market is headed for trouble. A mild winter across the northern hemisphere or a worsening macro backdrop could be catastrophic for gas prices in all regions. Bank of America said in a note in October. The problem for Appalachian drillers is that Permian producers are not really interested in all of the gas they are producing. That makes them unresponsive to price signals. Yeah, you don't want to hear that. Gas prices in the Permian have plunged close to zero. Wow. Well, I got to read that again. Gas prices in the Permian have plunged close to zero. So there's been stories for a while now how the natural gas is so uneconomic and there's so little storage and pipeline for it that they're just flaring it off. So they're burning the natural gas at the wellhead. They're flaring it off because there's no storage facilities because those are expensive. And the price of natural gas, it's too expensive to transport it somewhere with storage. That's sad. That's just unbelievable. Gas prices in the Permian have plunged close to zero. And have at times turned negative. Oh, I didn't finish that sentence. That's even worse. And have at times turned negative. But gas production in Texas really hinges on the industry's interest in oil. So the natural gas is a byproduct. But they're still flaring it off. So if you care about the environment, probably not good that all this natural gas byproduct that we could use in the future instead of coal is not being stored. If we're going to focus on economics and conserving, it would be smart to store this. But you don't see the states wanting to spend money on storage tanks and pipeline capacity to move it to storage tanks. This dynamic means that the gas glut becomes entrenched longer than it otherwise might. It's a grim reality plaguing the gas-focused producers in Appalachia. With capital markets growing less friendly, the only response, that's because the industry has been a poor stewards of capital. They are not growing efficiently at all. They're not using capital efficiently. They're not focusing on profits, free cash flow, good margins. They're not doing any of that. The only response for drillers is to cut back. Well, if they cut back and they have debt, then they're going bankrupt. IEFA notes that drilling permits in Pennsylvania in October fell by half from the same month a year earlier. The number of rigs sidelined and number of workers cut from payrolls also continues to pile up. Negative cash flow in the third quarter was led by Chesapeake Energy, minus $264 million. That's crazy. And EQT minus $173 million, but the red ink is only the latest in a string of losses for the sector over the last few years. As a result, the sector has completely fallen out of favor with investors. But gas drillers have fared worse, with share prices lagging not just the broader S&P 500, but also the fracking-focused XOP, Xavier Oscar Peter ETF, which has fallen sharply this year. In other words, oil companies have seen their share prices hit hard, but gas drillers have completely fallen off of a cliff. Chesapeake Energy even warned last month that if there was, that's bad grammar written in the article, that if there was substantial doubt about our ability to continue as a going concern. Its stock is trading below $1 a share. Even Cabot Oil and Gas, which posted positive cash flow in the third quarter, has seen its share price fall by roughly 30% year to date. Even though, quote, even though Appalachian gas companies have proven that they can produce abundant supplies of gas, their financial struggles show that the business case for fracking remains unproven. End quote, IEEFA concluded. So again, the shale oil and shale gas unicorns. Maybe someone will do some interesting fan art for that. We should put the shale gas and shale oil unicorns on the low interest rate party bus with the Silicon Valley unicorns. Silicon Valley IPO unicorns. It could be like the Tom Hanks movie Bachelor Party. Can make it wild and raunchy. The low interest rate party bus. Okay, so Wolf Richter put out an article November 23rd, 2019. Probably the last article I'll read before I end the show. All the links to the articles will be in the information and description section. I also found another article on some other oil stocks that are actually doing okay from December 5th from Anas Alik, a veteran investigative journalist and oil analyst. Okay, so this article is from November 23rd from Wolf Richter. Fracking blows up investors again. Phase 2 of the Great American Shale Oil and Gas Bust. In 2019 through third quarter of 2019, 32 oil and gas drillers have filed for bankruptcy, according to Haynes and Boone, which is a well-known law firm in Texas and Oklahoma, I think. Since the end of September, I've talked about their charts and articles in the past from starting like 5-6 months ago. Since the end of September, a gaggle, impressive use of the word gaggle there by Wolf Richter, of other oil and gas drillers have filed for bankruptcy, including last Monday, natural gas producer Approach Resources. This pushed the total number of bankruptcy filings of oil and gas drillers since the beginning of 2015 to over 200. Other drillers, such as Chesapeake Energy, are jostling for position at the filing counter. Chesapeake, the news just came out, I think, in the last couple days that Chesapeake got some type of very draconian bad term deal to buy themselves some time. So they're not going to go bankrupt probably in the next couple weeks, but in a couple months or 6 months from now, they bought themselves some time. That's about it. Chesapeake has been burning cash ever since it started fracking. And I highly recommend, if you have not done so, to read Bethany McLean's book, Saudi America. It's only like 3.5-4 hours on Audible audiobook. Really, really good. She spends about a little over an hour at the beginning of the audiobook, talking about Aubrey McClendon and Chesapeake Energy and how amazing Aubrey McClendon was at raising money and how wasteful he was at spending it. To feed its cash-burning machine, Chesapeake has been burning cash ever since it started fracking. To feed its, I love how Wolf Richter talks about this in his articles and his podcast, to feed its cash-burning machine. Its cash burn machine. It has borrowed large amounts and has been buckling under its debt for years, selling assets to raise cash and keep drilling for another day. But its debt is still nearly $10 billion. Its shares closed on Friday, so this was a couple weeks ago, at 59 cents. It's had a little rally. November 5th, they still probably have to do a reverse stock split because they're going to be in violation of exchange requirements. They're going to get a warning letter that they're going to be in violation of exchange requirements, so they'll probably try a reverse stock split soon. That's normally what mining companies and resource companies do to stay alive, and then that restarts the dilution cycle. In November 5th, in an SEC filing, it warned of its own demise unless oil and gas prices surge into the sky as soon as possible. Quote, if continued depressed prices persist, combined with the scheduled reductions in the leverage ratio covenant, our ability to comply with the leverage ratio covenant during the next 12 months will be adversely affected, which raises substantial doubt about our ability to continue as a going concern. In early 2016, during phase 1 of the oil bust, which had started in mid-2014, Chesapeake Energy had already used the threat of bankruptcy to push its creditors into accepting a debt restructuring. At the time, it was the second largest natural gas producer in the U.S. The debt restructuring reduced its debt burden somewhat and pushed maturities out, which then allowed it to borrow new money from new investors, aka suckers, and people desperate for any income, who were not paying attention to the risks, with probably the same people who bought 50-year bonds from Argentina who didn't learn any lessons. Maturities out, which then allowed it to borrow new money from new investors. This should be crossed out and say suckers, or pension fund, crossed out and say pension funds, with a series of bond sales. This coincided with the Wall Street floodgates reopening to the oil and gas sector when private equity firms, hedge funds, and distressed debt funds piled billions of dollars into the sector, and many of the oil and gas drillers were able to raise more cash to burn. Chesapeake's series of bond sales that it then undertook included, in January of 2018, $1.25 billion of senior unsecured convertible notes. The unsecured means they're towards the back. They're senior, so they're behind the senior secured debt holders. So if the senior secured debt holders get a haircut, the senior unsecured debt holders are getting an even worse haircut. There's a line of creditors, and the senior secured creditors are up at the front. Normally, unless it's like President Obama and he wants to change over 100 years of bond laws, and he wants to screw over an Indiana pension fund that was supposed to be at the front of the line for Government Motors when Government Motors went bankrupt, and those guys got screwed, and he moved the United Auto Workers in exchange for buying votes to the front of the line, so they got equity when the poor bondholders of this Indiana pension fund with senior secured debt got the shaft. issued these bonds at a discount. Okay, 1.25 billion of senior unsecured convertible notes with a coupon of 5.5% due in September 2026. It issued those bonds at a discount, but by July 2018, a few months before phase 2 of the oil bust set in, the bonds were trading at 103 cents on the dollar. Wow, so they actually had a temporary rally. On Friday, the last trade was at 45 cents on the dollar, giving these bonds a yield of over 21%. Yeah, they're not going to pay. When the bonds are trading at 45 cents on the dollar, it's obviously pricing in bankruptcy, and then experienced bond investors are trying to guess how much of a haircut they're going to actually get. Other exploration and production companies have seen their shares get crushed as reality began to set in. Whiting Petroleum had spiked to $370 per share in August 2014 when the oil bust was setting in. If you're not familiar with Whiting Petroleum, they're in North Dakota in the Bakken, so it's higher cost oil up there. When the oil bust was setting in, by the trough of phase 1 of the oil bust in February 2016, its shares had plunged to $14. I haven't looked at the share price of Whiting in a little bit, but the stock chart looked really, really bad, along with Oasis Petroleum, which is also up there in the Bakken. Oasis looked even worse. Oasis looked very close to bankruptcy the last time I looked at it, about a month ago. Plunged to $14, then new money started flowing into the sector, and its shares rallied by $55 by August last year. Then phase 2 of the oil bust set in, and after some disastrous earnings reports, its shares closed on Friday at, so this was a couple weeks ago, $5.34. So it went from $370 per share in August of 2014 down to, from 2 weeks ago, $5.34. So in only 5 years, a little over 5 years, 5 years and a couple months, it lost basically 99% of its value. From $370 per share down to $5.34 2 weeks ago. In June of 2018, Whiting Petroleum had sold $1 billion of callable senior unsecured bonds. Again, the unsecured is risky. The senior unsecured is riskier than the senior secured because senior secured has to have better collateral. With a coupon of 6.625%. The next call date is on October 2025 through September 2018. The notes were trading. So for the first couple months, these bonds were sold. For the first 3 months after these bonds were sold, they were trading at 103 cents on the dollar. The bonds actually rallied. Then phase 2 of the oil bust took its toll, and over a year later, the bonds closed at 57.8 cents on the dollar at a yield of 18.375%. So this was a couple weeks ago. So in barely a year and a half, since June 2018, the bonds have taken over a 40% haircut. Probably more than that if you were to check in the last couple weeks. S&P U.S. High Yield Corporate Distressed Bond Index tracks bonds that trade at a yield that is at least 10 percentage points higher than the equivalent treasury yield. Chesapeake's bond trading at 21% and Whiting's bond trading at 18.35% qualify for this index with flying colors. Of the 182 constituents of the index, many are energy bonds. Wow. So a lot of the S&P U.S. High Yield Corporate Distressed Bond Index are shale oil debt. This sounds like, again, not financial advice, just my opinion, this sounds like a potential opportunity there to bet against that index. It's not going to end well for the shale companies. Maybe if oil prices rally a little bit more and stay there, or we stay in mid-60, if we rally a little bit more and stay, maybe the shale oil companies can find more suckers to sell more debt or change the maturities on their debt. But this shale boom is looking like a bust, a larger bust soon. Now there are stories circulating of how billionaires who in 2016 believed the hype that the fracking bust was over have gotten tangled up and lost tons of money on their bets. Bloomberg recounts one such story of the brothers Ferris and Dan Wilkes in Texas. In 2002, they turned their stonemason expertise into Frac Tech Holdings. Chesapeake, the fracking pioneer with the collapsed shares and bonds above, acquired a 25.8% stake in 2006. They became billionaires in 2011 when they sold the remainder of the company to an investor group led by Temasek Holdings, which is owned by the government of Singapore, for $3.5 billion. They then bought large swaths of land in 5 states, becoming the top property holders in Montana and Idaho. However, not all of their wealth went into real estate. In 2016, the brothers started investing heavily in the fracking industry through their investment company, Wilkes Brothers LLC, including oil and gas drillers in the Permian Basin and suppliers such as frac sand supplier Carbo Ceramics, of which the brothers are the second largest investors. Back in 2015, Carbo Ceramics, I remember oil analysts talking about how they love this company, still trade at over $40 a share. By October 2016, shares had dropped into the $6 share range. Then the Permian boom started, and in early 2018, shares were trading at $12. That's a lot of volatility in only 3 years. But then the long, hard decline, a lot of volatility like that could be good for a trader. That much volatility is nuts. From 40 down to 6 and then up to 12. But then in all of 3 years. But then the long, hard decline continued as demand for frac sand vanished as drillers were running out of cash and cut back on their drilling activity. And on Friday, shares closed at 41 cents. Wow. The brothers, so 2 weeks ago, the shares were at 41 cents. That's signaling close to bankruptcy. Probably they might do a reverse stock split too. The brothers also invested $110 million in the above-mentioned natural gas driller Approach Resources, which filed for bankruptcy in November. They invested in Alta Mesa Resources, which filed for bankruptcy in September, and they invested in Halcon Resources, which filed for bankruptcy in August. Okay, so this is an important lesson to learn here, that if you own like 5 or 6 different oil company investments and a frac sand company, you're not diversified. Okay, I'm sure they were telling their friends and their family members, oh, we're diversified, it's fine. All of our investments aren't going to go bust. That was not diversification. I'm sure they told their friends that they were diversified, but it was not diversification. Bloomberg notes 8 of the 10 biggest holdings in a portfolio spanning more than 50 investments have dropped since June 2018, when they were worth almost $1 billion. In a filing last week, they reported stakes in just 7 entities worth a total of only $35.7 million. The combined value of those remaining holdings plunged by $171.2 million, or 88% since they were initially disclosed. Shale oil and gas business has turned the U.S. into the largest gas producer in the world, and then this year also the largest crude oil producer in the world. It's a huge business with lots of high-paying jobs, not only in the oil field, but in technology sectors, including software and hardware, manufacturing of heavy equipment, transportation, materials, and of course construction, ranging from pipelines and housing in the oil field to now partially empty office towers in Houston, where according to JLL, the office vacancy rate in Q3 climbed to an astounding 24%. Okay, if you want to read the rest of the article, it will be in the information description section. There's a couple more paragraphs here. It's really good. Agent Jeff Thomas says, fucking up, effing up the environment and losing money doing it. That's style. Yep. Yep, but it's this, the states are not, the regulators are not handling this right, unfortunately. There's a lot of problems with the regulators. The people who out there who say that the regulators are doing a good job, there's only rare exceptions, let's just say. I have so many bad stories from contacts I've heard in the business industry. It's really sad. French are fighting for pension funds, and soon everyone else will be too. Stagflate and tax and lie. And what did Christine Let Them Eat Cake Lagarde say? She said that the people in the European Union should only be happy they have jobs. Not their savings don't matter. Tomcat asked, is there any place where regulators are doing anything? Well, what do you mean by anything? Do you mean networking for a higher paying job? What do you mean? Anything. Do you mean using their expense account to cheat on their spouse at 5-star hotels and booking vacations to cheat on their spouse? Or buying hookers on business trips, in air quotes, with their government employee expense accounts? There are some good regulators. Unfortunately, a lot of them don't get promoted to the top. A lot of them are A lot of the bad people in the government agencies are the political appointees. There are some good regulators, but normally they get bullied or they get weeded out. Job at regulating for the people's benefit, part of their job description now. Yeah, I mean, I'm very jaded since I've lived in the Washington, D.C. metro area for almost 20 years now. And I've met a lot of people at a lot of these regulators at bars, at nightclubs, at charity events, out and about. A lot of them, some of the stories I've heard are truly unbelievable. Unless you've lived in the DC metro area, then you're used to it. You're used to some of the crazy stories. Yeah, I mean renting hookers, dude. Still, they should not be using government employees' expense accounts to pay for hookers. Or cheat on their spouse. And I've heard stories. A lot of them. So it's not just government employees looking at porn on their computer. It's actually much worse than that. Oscar is Harry. Are you talking about Oscar the Grouch? Let's see, 782. Let's see what the Fed's balance sheet does in the next couple weeks. If we see a big pop here, the market might get worried. Got to remember, next week, I didn't do a Repo Madness update really because the Fed balance sheet increased by, I think it was 11 or 12 billion, maybe 13 billion in the last week, which is kind of small compared to how much it's been increasing by. But if we get a big pop next week or the week after, and those the 28-day repo kicks in, I think, December 9th, the first 28-day repo, and then another 42-day repo kicks in, I think, next week too. So you'll have two 42-day repos of 55 billion, and then you'll have another 28-day repo kicking in. All those things layered on. That should increase the balance sheet a lot. The term repos are what increase the balance sheet a lot. So there's people ask, like, a lot of people don't understand this about the repos. There's different types of repos now. Okay, everyone's like, oh, they're only overnight. No, that changed. That changed after the first week of Repo Madness. It changed. Within about a week of Repo Madness becoming public on late night, Tuesday, September 16th and September 17th with the press releases, about a week later, the Fed announced term repos. And Danielle DiMartino Booth and others started heavily criticizing the Fed for the term repos, saying now the term repos are going to start going on the balance sheet, and they're worried that the term repos, the Fed was saying they're going to roll off, and they're not going to be added to the balance sheet. They're not going to roll over. The Fed was claiming this, but we know that the Fed's balance sheet is increasing a lot more than the not QE program of $60 billion per month. And so it's obvious to me that on the Fed's official balance sheet, a lot of these term repos are not rolling off. A lot of them are being rolled over and added to the balance sheet. And they may be rolled over permanently until the Fed fully nationalizes the repo market and establishes a permanently large repo facility. And a lot of people aren't familiar with this. Wolf Richter did a podcast on this in the last month or so on his YouTube channel, and he talked about how before the Fed actually started the QE programs with Ben Bernanke, the Fed actually was heavily involved in manipulating the repo market. And the Fed had a massive permanent repo facility that they eliminated because they didn't think they needed it after the TARP program and the QE program started. IBJI says, you don't think it's suckers buying shale oil bonds? It could be pension funds with bad money managers. Again, how is that not a sucker? The pension fund manager, the money manager, is a sucker. Or he's getting bribed. He's getting bribed by the Wall Street investment banks who are whining and dining him, or the shale oil companies. And yes, there is that. I've listened to long interviews with pension fund lawyers who are suing these pension funds for more transparency, where the pension funds eventually disclosed that they were ripped off by Wall Street investment banks and hedge funds and private equity. They're ripped off on bad deals and overcharged sometimes 9 or 10-fold by the amount they've disclosed in their fees. They're getting raped and pillaged with fees. There was one pension fund. Chris Martinson did an interview with a lawyer who sues pension funds for transparency. The guy sued a Rhode Island pension fund, and publicly in the public disclosure documents, the Rhode Island pension fund was claiming that their fees, they were only paying $9 million per year in fees to Wall Street investment banks. And after he sued them, they disclosed the real amount of fees was $90 million per year, not $9 million. RR says a sucker by another name is still a sucker. Yep, 100% agreed. It's truly I feel really bad for the people that are in pension funds and invested in them, because the majority of the pension fund management industry is not competent management. They're not good custodians, good stewards of capital. They're not investing efficiently. They go from bad deal to bad deal to bad deal. Aggregator, or you could fly in Instagram models and just take their passports, and then they can't leave the country. And I've heard this has been happening for a long time to a lot of like Miss USA pageant contestants and Miss America and Miss Universe pageant contestants. That they get the first class treatment, they fly into Saudi on like a private jet, and they get to stay at a 5-star hotel, and then their passports get taken and they can't leave. And I don't want my this video demonetized, so I can't go into any of the rest, but I've heard some really bad stuff. Jeff, no, it's just about what people can get away with, because it's not their own money in a lot of cases. Jeff, you're missing the point. They're spending other people's money for professionals. And to cheat on their spouse. They're spending other people's money, the taxpayers' money. It's fraud, and it's a felony. It should be a felony. If it was a private business, it would be embezzlement. If you're running a private business and one of your employees stole $20,000 or $30,000, wouldn't it be an embezzlement? But you can't charge thousands of people per year with embezzlement. Well, at least I don't think the government would want to do that. It would defeat the purpose of big government. And you can't have the sheeple questioning the purpose of big government. The tariffs are supposed to increase December 15th. There's supposed to be more tariffs increasing on Chinese goods. We'll see. Meanwhile, Trump is manipulating the stock market with tweets, and Kudlow is lying. Unbelievable. Yeah, making up on volume is BS. Saudi Aramco's IPO, the shareholders are not getting many rights. So the IPO, the shares may go up for Saudi Aramco IPO if oil prices rally, but the shareholders, if you go through the prospectus documents, the shareholders have almost no rights whatsoever. They have no voting rights. They have no say in how the companies run, other than dumping the shares and shorting the shares. They have very little say. Thank you for the super chat, Justin. Thank you, RR. I appreciate it. I'm glad you like the content, RR. Yeah, the European Union has a lot of pension fund problems too. It's a mess. Okay, well, I think that's it for today. I'll attach links to some of these articles in the information and description section. I did try to get a big name guest. It was Dan David, who was the star of the China Hustle documentary. So I will work on trying to get that rescheduled. Not my fault. It was booked hours before, and it was confirmed. So I will, and I did send some more emails. I was willing to wait on there for another hour. So we'll try to get that rescheduled. It was Dan David of the China Hustle. It's going to be a very interesting interview. I had a lot of good questions planned. Everything's still written down, so we can just hopefully do it in the next week or two, and we'll see. Okay, bye, everyone. And thank you very much to my over 200 now Patreon account contributors. Hopefully in 12 months from now can be 300. So if I can get the big name interview guests, maybe my Patreon will grow even faster. And also if I throw in some more occasional Patreon-only podcasts behind the paywall, maybe some articles once in a while, and my dozen or so monthly PayPal contributors. And we'll keep building this thing out with some of the best content, research, information, and financial education on the internet about investing in the economy that you won't find anywhere else, especially Seeking Alpha.